Hi, my name is Laurent Meunier from Safe Pacific Financial, and welcome back. If this is your first time with us, welcome for the first time. Happy to have you here. If you've watched any of our other videos, you know that we talk a lot about financial strategies that involve borrowing from the cash value of your life insurance policy. In today's video, we're going to explain what is cash value, what types of life insurance have cash value, which ones don't, and also how do you actually access it. So, what is cash value? Cash value of a life insurance policy is the value that the policy's accumulated since the issue date. And the accumulation is based on your premium payments plus any excess cash that you've deposited since you started the policy. The cash value within a permanent or whole life policy is often broken down into two parts. There's a guaranteed cash value and then a dividend cash value. The guaranteed value is your worst case scenario cash growth in the policy. To be real, we don't actually pay too much attention to this when we're running scenarios for people, but it's nice to have. The dividend value only exists in the participating whole life policies, and you can access this through withdrawals or policy surrenders or policy loans. We really do pay more attention to this number when working with clients, and we even run those numbers at a negative 1% to be more conservative. Which types of policies offer a cash value? Well, most permanent life insurance policies build a cash value. There's two main types. There's whole life insurance and universal life insurance. Whole life is often viewed as a simpler version of permanent insurance because the premiums are fixed and it often offers guaranteed benefits, meaning that, when you buy one of these things, you know exactly what you're getting. Many whole life policies also produce a dividend, which generates a variety of options for you. Right? So whole life insurance is generally, there's two types. There's non-participating and participating. The non-participatings do not generate dividends for the policyholders. The participating policies, they generate an annual dividend, which allows the insured to share in the profitability of the insurance company's investments. As you'd expect, insurance companies in Canada usually invest quite conservatively. And because of this, over the last 100 years, they've consistently paid dividends to their participating policyholders. So right now, the dividend's somewhere between 5 and 6%, depending on the company you work with. Universal life insurance is another popular form of cash value life insurance. And what it does is separates the investment portion from the life insurance portion. And some policies offer like dozens and dozens of investment options. The main difference of whole life and universal life is the flexibility. The policyholder can decide how much they want to contribute throughout the policy's life. They also have a wide variety of investment options when you're doing universal. Which types of policies don't have cash value? Well, term insurance doesn't generate cash value. So you have term insurance for say 10 years or 20 years or 30 years or even 100 years. And it's usually designed to cover something specific. And this makes it actually much more affordable. If you have a term policy, this doesn't mean your policy is bad. It just means it's not designed to generate a cash value. Now you've got cash value. How do you access it? So you can usually access this value via a surrender of the policy or a policy loan, or you can use it as collateral. If you do it as a surrender, you're basically giving up the policy back to the insurance company and they're giving you the cash. Certain policies have policy fees or surrender charges. So this would be deducted from the cash that you receive, and you should definitely know about that in advance. Also, if you surrender the policy and take the cash, you need to be aware that there may be some potential taxable gains. If you have questions, make sure you talk to the advisor who set up your policy in the first place to find out. You can also access the cash through policy loans or collateral loans. There's two broad ways you can do this. You either borrow from the insurance company that you set up the policy with, or you borrow from a bank. The insurance company is actually contractually obligated to give you the loan if you ask for it. Plus, it's super easy. There's no credit check, no questions about what you want to do with the money. And it's literally a one-page form that you send in, they give you the money. When you're borrowing from a bank, they do run a credit check on you. And generally the loan that they give you is a line of credit, and it'll be based on the cash value of your policy. Because these life insurance policies, the asset that you're using to secure the loan is so safe and secure, banks will usually give you 80 or 90 or 100% loan to value for that. That's it for today. If you found this video helpful, please like it and subscribe and share to somebody else who would find value. If you want to talk to us and set up a free consult to discuss setting up this policy with a cash value for yourself or your family or your company, fill out the form on our website. It's safepacific.com. That comes straight to me and we'll reply to you within 24 hours on business days. That's it for tonight, and I will see you later.